Hello everyone, welcome to this video on Forex, or the foreign exchange market. What we're going to do is pick up from the primer on how money works, where we looked at the distinction between money and value, and how money really, when you boil it down, is an abstracted form of value. And what that also means then is that the precise valuation for any given unit of money or any given currency is always in flux, affected by things like inflation, as well as normal supply and demand pressures. So if we take that understanding of money and move forward and try and understand how currency exchange works, so if all currencies today are essentially fiat currencies, so currencies which have no inherent or intrinsic value, but rather their valuation is dependent upon who wishes to actually exchange something else of value for them. So the valuation of any given fiat currency is dependent on the political and social, particularly social and economic structures within any given society. This also means that if we're exchanging currency between different societies and between different countries, then we have that fundamental problem that there's no fixed internal value for any modern currency, so there can be no meaningful fixed external rate of exchange between different national currencies either. Now, this isn't a new problem. So as long as we've had different states, so different empires or different forms of social organization that have used different forms of currencies or different forms of captured or abstracted value, we've always needed to have an exchange between them. So we understand that international trade has existed pretty much as long as human societies have existed. We've got examples of trade between different societies going back millennia. So we've always had this problem, and there's been various different solutions to it, particularly the use of currencies that have had value across different societies. So forms of Roman coinage, for example, are a good example of this. But our modern currency exchange market has existed since the 1970s. So after the Second World War, the Bretton Woods system and the Washington Consensus that really did tightly regulate money supply and exchange had a form of a mutually agreed between different state governments exchange rates, and this is where the US dollar came to prominence as the world's reserve currency, particularly bolstered by things like the Marshall Plan, which really did establish the US dollar as the preeminent and the safest form of storing value. This isn't quite the situation today, so we don't have the same tightly regulated money supply that we had prior to the 1970s. Instead, we have a far more accurate valuation of different currencies. So rather than national banks or national governments determining an arbitrary rate of exchange with lots of political considerations, instead we have a decentralized network of buyers and sellers. So essentially a global marketplace which determines how much currency A is worth for a fixed amount of how much of currency B. So essentially how much buyers are willing to buy for and how much sellers are willing to sell for. Now this global decentralized network is a currency exchange market. So when we think market, we shouldn't think some kind of physical location. We're talking about a space essentially, so a transphysical or a metaphysical space where buyers and sellers are able to meet either physically or virtually through telephones, telegraphs, whatever means of communication, and arrange the purchasing of one currency and the selling of another currency. So the core purpose is to enable this exchange of currencies. So that's what we mean by a currency exchange market, and the title of the video indicates the current global market really is Forex, the foreign exchange market, which exists in some form pretty much 24 hours a day, with the exception of a small weekend window. It's hard to understate. You really can't understate how critical this is to international business. Without this currency exchange market, without Forex, wealth and stores of value like currencies would be locked within national boundaries. So you wouldn't be able to actually transfer any type of wealth or value across borders, unless it, of course, is in the form of products and services. But then payment for those products and services would become extremely difficult, if not impossible. So what international trade would be reduced to would be essentially barter trade. We will exchange X number of oil barrels for X amount of medicines. There would be no form of international business, which is quite distinct from that type of barter trade. So this decentralized market is really core to being able to actually function, for international businesses to function as they do today. And it's almost impossible to understate how, or overstate just how critical Forex is, not just to repatriating profits, but also just to day-to-day operations of international businesses. Just before we look at the Forex market itself, it's worth just taking a brief look at just some of the impacts that this kind of open, non mutually agreed upon exchange rate, so this unfixed dynamic exchange rate and global currency exchange market really demonstrates. It shows how little in many ways controlled governments have over domestic economies. So the integration of domestic economies into a globalized economy, where we don't just have international trade, we have, in a very meaningful sense, the globalization of economic activity. So we can see here any attempt to try and fix the value of currency, so exerting direct monetary control over national currencies, really doesn't work in any meaningful way. So black markets will spring up almost instantly. The real market value will still be assessed and widely known. And any attempt to try and insist upon a fixed upon exchange rate, so in the case of Zimbabwe, where there was a fixed rate for the official rate was fixed against the US dollar, and there was an official 0% inflation rate. There was clearly no practical impact, and there was a huge collapse in value. So the Forex market exerts far more control in situations like this than governments can through direct control. It's worth pointing out that governments don't just have the option of direct control and pegging currencies to another, or just by insisting upon some kind of fictitious inflation rate. They have lots of other monetary tools at their disposal, some of which we've seen repeatedly over the last 10 years, things like quantitative easing, printing additional currency, interbank loans. So there are lots of other tools, but direct control is simply not feasible, and a large part of this can be put down to just how integrated economies are into this global economy. So with that said, if we move on and look at Forex itself, so this is the foreign exchange market. The title is very deliberate in the sense that it is a single decentralized distributed market. So it's not controlled by a single company. It's not a brand name. It is a decentralized distributed market. So think of it similar to the internet. So just as there isn't a single company which controls the internet, you're not connecting to a central server. You are instead connecting to your devices, connecting to other devices which are serving up web pages, transmitting communications and data between them. That's a far more accurate model of how Forex actually works. It's not a brand name. It is absolutely a decentralized distributed network which operates across. I mean, there's major centers for Forex, like London would be one of the major ones, Singapore, Hong Kong, New York, but nonetheless is decentralized and distributed all around the world. It is the largest largest market in the world just by sheer turnover. So annual turnover exceeds 4 trillion comfortably. Um, it's not under the single sovereignty or regulation of a single national government. It's worth pointing out that while the turnover figure is staggering, and it is by sheer volume the largest market in the world, this doesn't mean it's the highest value market in the world. The trades are generally low margin but very high volume. So you're not going to get 10%, 20% returns or anything silly like that by engaging in Forex. The returns are far, far lower in a percentage sense, but because the sums involved are so large, it still can be a lucrative market. However, the primary purpose is to enable the engine of the globalized economy. Again, without Forex, we wouldn't have anything like the kind of globalized economy we have today. You wouldn't have any real meaningful international business, and you'd be restricted to very particular forms of barter trade instead. So we said that it was mostly continuously operating, with some exceptions. So there is a break, a shortened break for weekends. So trading begins Sunday 10 p.m. Sydney time, and will stop Friday 10 p.m. New York time. So there is a short break for the weekend, but it is largely in continuous operation. As said before, it is geographically dispersed, but it does have clusters, and the city of London, so not just London as we know it, but the square mile is a particular cluster for Forex. It's not the same as a stock market where any individual investor can have the same level of access as any other investor. They are very much different levels of access based on the volumes of trades. So we see the interbank market. So if you're a international bank or international finance institution, then you'll get access to the highest levels of Forex based on your volume itself. Multinational corporations would certainly have significant access because of the frequency and volume of their own trades in Forex. And then you would have hedge funds, and a level below that, other investors. So attempts at playing Forex like you would play the stock market won't really work in the same way at all. The reason why international businesses and multinational corporations need such access to Forex can really be broken down in two distinct forms, or two distinct reasons. So the first would be just the regular day-to-day operations that require frequent changes and frequent exchanges from one currency to another. So regular expenses, employee wages, supplier payments, moving currency up and down the supply chain, which is in many cases distributed around the world and operates in various different currencies. All of these require very, very large amounts of currencies to be exchanged on a regular and frequent basis. As well as this, you have things which are not regular but still will be very high volume, so new capital going for investment purposes, or the successful investments yielding large profits and large revenues, which then would get typically either repatriated back to the country of origin, so the headquartered country, or to other parts of the company based in other regions of the world. So those are the reasons why international businesses would have such constant and high level and high volume engagement in Forex. But we also have some significant risks. So we spoke before about how money fundamentally, any currency today is a fiat currency. It doesn't have any fixed or inherent or intrinsic value, and the value can be affected by a broad range of factors, and therefore the exchange rate with other currencies will be constantly shifting. So if we try and understand why currencies shift and how to understand the shifts in the exchange rate between different pairs of currency and Forex, we generally have three distinct factors or types of factors that will either move those the exchange rate between currency pairs up or down. So the first is relatively straightforward. You'd have direct economic factors that would affect the exchange rate itself. So these can be the actual internal or domestic inflation rates and trends. So if your currency is losing value domestically, then that's obviously going to have a direct and immediate impact on the exchange rate with external and foreign currencies. This can also be down to the perception of inflation rising, or looking at the chances of inflation rising. We have to remember that it's not the actual rise in inflation itself that will mark the change in the valuation of a currency, but rather the willingness of buyers to purchase that currency for a particular price. So if there's a perception that the trend for inflation is going up, or the risk of inflation is going up, that will trigger a fall in the valuation of Forex. So it's not an algorithm, is not some kind of direct input or valuation. It is based upon the willingness of people to purchase at particular prices and the willingness of people to sell at particular prices. So as a result, other economic factors can have a significant impact as well. So GDP, employment levels, retail sales, all of these things that give indications as to a particular country's economic health and growth potential will either stimulate demand if they're generally strong indicators, or they will reduce demand if they're weak indicators. Now, as well as these economic factors, we have more direct political factors as well. So generally speaking, when you have a country that's experiencing political turmoil or particular instability, then that will not only have consequences for the economic outlook of the country, it also reduces the Forex, the market's confidence in monetary and fiscal policy often. So political upheaval, political instability can directly tie in the collapse of a currency's valuation on Forex. Now, a combination of these two, but underpinning them and of quite important, quite fundamental importance, would be the fact that, like any collection of individuals, the marketplace, the Forex itself, is really rational. So to think that the market traders, or people who are actually purchasing and selling currencies in Forex, or whether they're representing massive institutions and corporations, or whether they're representing hedge funds, or whether they're just individual independent traders, we shouldn't think that they are purely rational actors, but rather recognize that market psychology is a entire field of study unto itself. Markets can become spooked. You can have rumor mills. You can, and we have seen seemingly irrational reactions across decentralized distributed networks like Forex. So we have to take into account psychological, cognitive, emotional, cultural, and social factors when looking at decision making on Forex.